welcome to FM with Sir Evans. In today's session, we will discuss the second part of the second competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. So we start off with cost of capital. So what is cost of capital? Is the rate of return that a firm will require from investment in order to increase the value of the firm in the marketplace. This is by John J. Hampton. So the idea of cost of capital is that what rate will help us increase the value of the firm when we engage in an investment. This cost of capital can be computed by looking at two important parts. We have the measurement of the specific cost. So the cost of capital can relate to the cost of the equity, cost of the debt, cost of any preference shares, and cost of retained earnings. So you first measure this specific cost, then you measure the overall cost of capital, also the weighted average cost of capital. So we'll look at each of these individual sources of capital and how to compute their cost. So cost of equity. So this is the minimum return that a firm will earn on any equity that is used to engage in an investment of the entity. So there are a number of methods. We have the dividend price plus growth approach, where dividend is growing, dividend price approach, where there is no growth in the dividend. We have the earning price approach, capital asset pricing method, CAPM, and the realized yield approach. So under the dividend price approach, the cost of equity capital is the rate of expected dividend, which will maintain the present market price of the equity shares. So with this type of approach, we are only looking at the dividend and also the price of the equity shares. And it's a function of DO over PO, where DO is the dividend per equity share and PO is the net proceeds of equity share. So cost of equity, which is KE, is equal to DO over PO. So we'll take an example. A company issues 10,000 equity shares of 100 cedi each at a premium of 10%. The company has been paying 25% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future, which will compute the cost of equity capital. So in this scenario, we can see that there is dividend there, and we can see the company issuing the shares at a premium of 10%. So to find our cost of equity, we need to ask ourselves, how do we get the dividend, DO, and how do we get the PO? So DO, as we are being informed, is 25%, 25% dividend, which is being paid out. So each of these shares is 100 Ghana cedis. So 25% becomes 25 being the dividend paid out. And because the shares are issued at a premium of 10%, then the value of the price of the share becomes 100 by the 10%, which is 110. So our cost of equity becomes 25 over 110, being 22.7% for the cost of equity. Now, the dividend price growth approach. So this is often computed considering that there's going to be a growth in the dividend. There's going to be a growth in the dividend over a number of years. So KE becomes DO 1 plus G over PO plus G. So DO 1 plus G is the same as D1. So D1 means that there's been a change in the dividend over a number of period. So we'll look for our D1 or our DO and the 1 plus G. Then we look for our PO and our G. Our G there is our growth in expected dividend. Okay, so we'll take a scenario. A company plans to issue 10,000 new shares of 100 cedi each at par. The floatation costs are expected to be 4% of the share price. The company pays a dividend of 12 cedi per share initially, and growth in dividend is expected to be 5%. Compute the cost of new issue of equity shares if the current market price of an equity share is 120 cedis. What is the cost of existing equity? So in this scenario, we are being asked to find the cost of equity. So when you are asked such a question, then you ask yourself, what variables do I need to solve this particular question? So we've learned that we need our DO, and then we need our growth rate. So in the question, it says the company pays a dividend of 12 cedi per share initially, and the growth is expected to be 5%. So we'll be having 12, then bracket open 1 plus 0.05, where 0.05 is the G, the growth rate. And then we need the net proceeds of the equity shares. So the net proceeds of the equity shares becomes the share price minus any cost of issue. So the share price in this question is the last part of the question says, if the current market price of an equity share is 120 cedis and 4% is the cost of issuing, therefore 120 minus 4% of the 120 is 4.8. So that becomes the net proceeds of the equity share. Then our G is 0.05. So we'll be getting 16% as our cost of equity for this particular scenario. Earning price approach. So it is based on the future earning prospects of the equity. So KE becomes E, where E is the earning per share, over PO, where PO is the net proceeds of the share. So a firm is considering an expenditure of 75 cedis for expanding its operation. The relevant information are number of existing equity shares is 50, 50 being the number of shares. Market value of existing share is 100, and the net earnings is 500. So we should compute the cost of existing equity share capital and of new equity capital, assuming that new shares will be issued at a price of 92, and the cost of new issue will be 2 cedis. So to find the cost of equity for existing shares, so the existing shares, we need the earning per share divided by the PO, which is the net proceeds of the existing shares. So the existing shares earnings becomes 500, as number of existing shares is 50. So 500 over 50 becomes our earning per share for the existing shares. Then our proceeds, the market value of existing shares is 100 cedis. That gives us 10%. For the new share, the earning per share is the same, 500 over 50, but then the net proceeds of the share changes. So we realize from the last sentence that new shares are issued at 92 Ghana cedis, and the cost of the new issue will be 2 cedis. So 92 minus 2 being 90, and then we get the cost of the new shares to be 11.1%. Now, the realized yield approach is calculated on the basis of return that is realized by the investors of the company on their equity capital. So this is a function of our present value, the discount factor, multiplied by the DO, being the dividend per share. Okay, so we go on to look at the capital asset pricing method. So under the capital asset pricing method, we are considering the cost of equity to be the risk-free rate of return, and also a beta factor is introduced, and a return from the market is also introduced. So the cost of equity capital becomes RF, where RF is the risk-free, plus the beta into brackets, the return from the market minus the risk-free rate. So we'll take a question to look at that. The risk-free rate of return is 7%. The average market return is 11%. What will be the return expected from a share whose beta factor is 0.9? So considering the capital asset pricing method formula, we know our beta is 0.9. Our risk-free is 7%, market return is 11. When we put that in the function, we'll be getting 10.6% to be the cost of equity. And the second part of the question says, what will be the share's expected value if it is expected to earn an annual dividend of 5.3 pesos with no capital growth? So from previous formulas, we remember the dividend price approach, where KE being the cost of equity is equal to your DO divided by your PO. So in this instance, we've found our KE under the CAP PM method. So our KE is equal to, our KE being 10.6% will be equal to our DO, which is 5.3 pesos divided by the PO. So this question is asking us for the expected value of the share. So it's a change of subject, which will be PO to be 5.3 pesos divided by our 10.6% cost of equity. to give us 50 pesos value of the share. However, there are some problems in applying CAPM in practice. We need to determine the excess return, and also we need to determine the risk-free rate. There could also be some errors in the analysis which is used to calculate the beta values, and the beta values may also change over time. Now, the CAPM is also unable to forecast accurately the returns from companies who have very low PE ratios, and also there may be some adjustments that will be involved due to some seasonal effects and also daily effects. Okay, so we move on. If we are computing the beta factor of a company's security, you realize that under the CAPM, there is a beta factor which is introduced. That can also be calculated, and that will consider the correlation coefficient of return from securities with return from the market. We also look at some standard deviation of returns of security S and standard deviation of return of the market. So that's a function of the correlation, the standard deviations of both the security and the market, to give us a beta being to help us find the beta. Now, the beta factor for the share of an individual company must always be higher than the risk-free beta factor, and also it should be less than 1.0 if its systematic risk is less than the systematic risk for the market portfolio as a whole. Now, systematic risk is the risk that cannot be eliminated by diversifying. It will also be more than 1.0 if a systematic risk is greater than the systematic risk for the market portfolio. So those are some criteria that will help us in arriving at our beta factor. How then do we estimate growth of cost of equity? So in the dividend price plus growth approach, we realize that a growth factor was introduced. So how do we estimate this growth factor under the cost of equity? So this growth is the growth rate that investors will expect to occur in the future. So we can get that by one extrapolation of historical growth. So there is a geometric mean growth rate formula, which is the nth root of the value at the end of the period of n years divided by the value at start, all of this minus 1, and that will help us to estimate our growth rate. So an example, a company has paid out the following dividend in recent years. We have 100 for 20x1 and 110, 20, 34, and the last year 20x5 is 148. So how then do we estimate the growth? We can see that the growth is not even. So using the geometric mean growth rate approach, our growth is equal to the fourth root. Now the 4, which is the n, is the number of terms in the series. So the years of growth. So we realize that from 20x1 to 20x2 is 1 year, 2 to 3 is 2, 3 to 4 is 3, and then 4 to 5 is 4. So though there are 5 years there were 4 years of growth. So for the fourth root of 148, which is the value at the end of the period and value at the start being 100. So all of that minus 1, you get 10.3% as our growth rate. The other method of estimating your growth is the Gordon's growth model. So it uses the earnings retention valuation model. So this particular one considers the proportion of earning you are retaining in the business and the rate of return that the company will make on its investment. So G is equal to BR, where G is the annual growth rate in dividend, B is the proportion of earnings retained, R is the rate of return that the company will make. So we take a scenario, a company has just achieved annual earnings per share of 50 cedis, of which 30% has been paid in dividend and 70% has been reinvested as retained earnings. So the company is expected to retain 70% of its earnings every year and pay out the rest as dividend, and the cost of equity capital is 8%. So to estimate the growth rate, we need to find first our proportion of earnings which is retained. So we can see that in the question has been paid in dividend and 70% has been reinvested as retained earnings. So 70% is our proportion of earnings that is retained. The cost of equity capital or the rate of return is 8%. So when you use these two, you get 5.6% being the growth rate in dividend. Okay, so these are the various methods you can compute for the cost of equity. So now we will move to the cost of debt. So first of all, we'll start with the cost of irredeemable fixed rate debt. So these are bonds which are irredeemable, and they will also return fixed interest at the end of each period. So we have market value of such shares to be the interest I, annual interest payable I, over the pre-tax cost of debt. So MV is equal to I over pre-tax RD, and to find the pre-tax RD is the I over MV. And also with the post-tax, we have I to be 1 minus T, I 1 minus T divided by the post-tax RD. Therefore, our post-tax RD is equal to I 1 minus T over MV. So RD is the cost of debt, I is the annual interest payable, T is the rate of tax on company profits, and MV is the S interest market value of the debt. So we should know that when it comes to debt, they are performed on a nominal amount of 100 or 1,000. Okay, so the coupon rate of interest on the company's irredeemable bonds is 6%, and the market value of the bond is 103.60. The tax rate is 25%. So how do we find the cost of debt? So we realize that the market value of the bond is 103.6, which means that the nominal amount is 100. So with this one, for instance, if you want to find the post-tax cost of debt, it will be the I, which is the 6%, multiplied by our 100 to give us 6, being the interest payable, divided 1 minus T. We introduced 1 minus T, so 1 minus 25, divided by the market value of 103.6, and that will give us our post-tax cost of debt. Now, cost of redeemable fixed rate debt. So these are for bonds which can be redeemed upon maturity. So it's calculated as the present value of the future cash flows which are received by the lender, discounted at the pre-tax cost of debt. So this, to find the value of the redeemable debt, we find the present value of the future cash flows which are received by the lender, and also those that are paid by the company at the net of tax relief on the interest flow. So these are discounted at the post-tax cost of debt. So the lender, we discount it using the pre-tax cost of debt, and for the company who is paying it at the post-tax cost of debt. Okay, so a scenario, a company has issued 7% loan stock and the annual interest has just been paid. The bond will be redeemed at par after 4 years. The lender's required rate of return is 8.14%. So we should find the market value of the loan stock. So for the first scenario that I mentioned, I said 6 was the interest, and then the market value was 103.6. So that will give us 5.8%. That's for the pre-tax cost of debt. For the post-tax cost of debt, then you are going to introduce 1 minus T on the 6. And also that will give us a post-tax cost of debt. So for the second example, as I mentioned, we are finding the present value of the various interests that are payable. So it is 7% loan stock. So the interest there is 7%. So we find the interest over that particular 4 years. And then you are going to discount it at the 8.14%, using that as a discount factor. So at the end of the period, you realize that the net present value becomes 96.25. Okay, we go to cost of redeemable debt. Cost of redeemable debt. So cost of redeemable bonds is their redemption yield, so at which the bonds are currently trading in the bond market. So to find a redeemable debt cost, we use an approach called the IRR, internal rate of return. So with this one, we estimate one discount factor, and we use it to find the present value of the various cash flows, and we estimate another discount factor, and we use it to find it. Then we input both the discount factor and their present values into the formula DF DF2 plus PV2 over PV2 minus PV1 multiplied by DF1 minus DF2, where PV2 is the DF2 is the discount factor 2, and the PV2 is the present value using discount factor 2. DF1 is the discount factor 1. PV1 is the present value with discount factor 1. So we'll take an example. The current market value of a company's 7% loan stock is 96.25. Annual interest has just been paid. The bond will be redeemed at par after 4 years. So the rate of taxation on the company profit is 30%. We should find the after-tax cost of the bond for the company. So for this question, we first need to identify the various interest less tax. That's the interest I1 minus T, because they are the after-tax cost of bonds is what we are looking for. So the rate of taxation is 30%, and it's a 7% loan stock. So 7% on the 100, which is the nominal amount, becomes 7. Then 7 minus T, meaning that 7 multiplied by 70%. So that will give us 4.9 being the annual interest. Now the market value of the bond is 96.25. So at year 0, that becomes our outflow. And then our redemption value to be redeemed at par after 4 years. We are redeeming the 100 being the nominal amount at the end of the whole period. So when you find the present value of all of these, you first use any rate that we want. So we could use 6%, and then when we are done, we can use another rate, say 5%, and then we input all of these into the IRR formula, and that will give us an IRR of 6% if you had to do it well. Cost of convertible debt. So when you want to find the cost of convertible debt, is the higher of the cost of the bond as a straight bond that will be redeemed at maturity, and the IRR of the relevant cash flows, assuming that the conversion of the bond into the equity will take place in the future. So we'll take an example. The current market value of a company's 7% convertible debenture is 108.7. The annual interest has just been paid. The debenture will be converted into equity shares in 3 years' time at a rate of 40 shares per debenture. The current ordinary share price is 3.2, and the rate of taxation on the company profit is 30%. So with this particular question, we are looking for 2 instances. If the straight bond will be redeemed at maturity, and then the IRR of the relevant cash flows, assuming that the conversion of the bonds into equity will take place in the future. So with these 2 scenarios, you find the higher of the 2. So the higher of the 2 becomes your cost of convertible debt. So that would also give us 9.9% as the internal rate of return, as the cost of convertible debt. Okay. So we move on. There is a question which I would like us to look at. The company has issued 4% convertible bonds that can be converted into shares in 2 years' time at a rate of 25 shares for every 100 cedi of bonds. It is expected that the share price in 2 years' time will be 4.25. If the bonds are not converted, that will be redeemed at par after 4 years. The yield required by investors in these convertibles is 6%. What is the value of these convertible bonds? So in the same way, we are finding the higher of, if the bonds are going to be treated as a straight bond, that will be redeemed at maturity. And then we also use the redeemable, that's the relevant cash flow, assuming that the conversion of the bond into equity will take place in the future. We find the IRR of that, and the higher of the 2 becomes your cost of convertible bond. Okay, cost of preference shares. So these are irredeemable preference shares. So the cost of capital for these preference shares is calculated in the same way as the cost of equity, assuming a constant annual dividend and using the dividend valuation method. So the present value of perpetuity, that's MV, to be D over RP, where D is the expected future annual dividend, our MV being the share price ex dividend, RP being the cost of preference shares. And we have the cost of redeemable preference shares. So the cost of these shares is calculated in the same way as the pre-tax cost of irredeemable debt, So dividend payments are not subject to any tax relief, and therefore the cost of preference shares is calculated ignoring the tax. We go to weighted average cost of capital. So what is the weighted average of the after-tax cost of all sources of capital? You would remember from the beginning that we were going to find the cost of capital for each specific source of capital and then the overall cost of capital. So this is the overall cost of capital. So we look for all the various sources of capital to the entity. We find then we use it to find the overall cost of capital. So weighted average cost of capital is equal to, so depending on the number of sources of capital, we have the RE being, we have equity, debt, and preference shares, then the weighted average cost of capital is RE, MV over RE being the cost of equity, MV being the value of the equity over the total value of capital, plus RE being the cost of debt, then the value of the debt over the total market value, and RP being the preference shares, cost of preference shares, and the value of the preference shares over the total market value. Okay, so a company has 10 million shares with a value of 4.2, whose cost is 7.5%. So looking at this alone, we can tell that that is for equity. And for this particular one, the cost of equity is 7.5, and then the value of the equity is, a company has 10 million shares, each with a value of 4.2. So the total value of the equity is 42 million. And then to find the total market value, we need to know the value of each and every source of capital. So we go on, we are done with the equity. For the next one, it says it has 30 million cedis of 5% bond with a market value of 101 and an after-tax cost of 3.5%. So for this one, we realize that the cost of the bond is 3.5%, and then the market value of the bond, you realize that the market value is 101. So I mentioned that the nominal amount of each bond is 100 or 1,000. In this instance, it is 100. So for its market value to be 101, meaning that it has a premium of 1%. So it means that the value of the bond is going to be the 30 plus the premium. So 30.3 million becomes the value of the bond. And then that would also be added to the value of the equity we got initially, waiting to find the other sources of capital. So we find the total market value. It also has a bank loan of 5 million, whose after-tax cost is 3.2%. So the cost of the bank loan is 3.2%. The value is 5 million. And there is a 2 million 8% preference shares of 1 cedi, whose market price is 1.33 per share, and the cost is 6%. So the cost here is 6%. And then to find the value of the preference shares, it gives you 2.66%. And then that's what you also use in the formula for the weighted average cost of capital. So we realize that for each of the sources of capital, we are asking ourselves, what is the cost of that source of capital? What is the market value? We sum all the market values, and then we'll be able to get our weighted average cost of capital to be 5.7%. Okay, so the total market value of a company is often the earnings 1 minus T divided by the weighted average cost of capital. So the lower the WACC, then the higher the total market value of the company for any given amount. So the higher the WACC, the lower the market value of the company. So at each point, we are looking at how we can reduce the weighted average cost of capital to give us a higher market value. So weighted average cost of capital can be used for projects with similar risks to the company's existing risks that are small compared to the size of the company, and the project must be financed out of a general pool of finance. So floatation costs, these are costs which we incur if we want to issue new securities. So they include underwriting fees, legal and advisory costs, registration fees, and so on. So the size of the cost depends on the type of security being utilized, and floatation costs and the amount raised. So the total amount raised will be the amount needed for the project divided by 1 minus F, where F is the finance cost. So when we are budgeting, the flotation cost must be incorporated into the investment appraisal process. And we calculate it by two approaches, where the RE being the cost of equity to be equal to the D1 plus G over market value 1 minus F plus G. So you realize that in some of the examples we looked at earlier, there were flotation costs involved, and we had to deduct that from the market value to give us the net proceeds of the market, net proceeds of the various shares. So the approach 2 is that cash will be raised to fund the project, and the flotation costs can be incorporated into the project cash flows. So it's either you are incorporating it into by the first approach, or the second approach is that when you are finding your present value of the various cash flows, you include the flotation cost as an outflow, and that would also help you to arrive at the appropriate market value. So I'd like to thank you very much for staying with me till this point. There's a link below where you can join a Telegram channel created for paper 2.4. There are other students preparing for the paper, so it will be a great place to interact. And you also have access to the various slides and other relevant materials to aid in your preparation for the exam. So thank you once again, and I'll see you in the next session.